Good evening, traders. Today's Sunday, January 29th, ahead of FOMC week. But I want to kick this one off a little bit differently this time. I want to show you, as you see on your screen, the world champion of the Rubik's Cube and how he can solve it in 17 seconds blindfolded. He doesn't need his eyes to see what's happening. Okay? What you're going to see today in today's episode is your eyes have deceived you. I'm going to show you what the market makers have really been up to the month of January. Your eyes have lied to you. You're going to see that momentarily. As you see here, it is not essential to see the cube colors in order to solve the Rubik's Cube. It is not essential. And I liken that to mean it is not essential to rely on price action and price patterns. You're going to see that momentarily, that you would have been deceived by the ultimate lie by the market makers in the month of January, had you relied on price patterns and price action to make trading decisions. So as you also see here, he applies thousands of algorithms. Where have I heard that word before? In my previous videos, I have said over and over again, it's just math and algorithms. It's not related at all, for example, to what I personally think Jay Powell is going to do this Wednesday, or what he's going to say. It's not relevant at all. That is not the question at all, because I can promise you with 100% certainty that question of what will Jay Powell do this Wednesday is not written in the algorithm code. I promise you that is true, because I'm a programmer myself. I don't write stuff like that. Well, depending on if he says this, then you're going to do that. Oh, no, 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 no. It's already in the algorithm. The markets already know exactly where they're going to go, and I'm going to share that with you today. They already know exactly where they're going to go. You're going to be actually surprised at today's episode at what you see. So regarding to algorithms, back to that topic, look beyond the price patterns, and you will see the algorithms embedded in the channel trend lines, the EMA 50, and the SMA 20. And you are going to see that clearly today. It's going to blow your mind when I show you what the market makers are really up to. This is the 65-minute chart over the past month. Actually, this goes all the way back to December. Okay, this is the month of January that you're looking at right now. You see 3 rising wedges there? Price patterns? I do. Do you see a quadruple top? 1, 2, 3, 4. Do you see a double top? 1, 2. I do. Maybe you throw that a triple top. I see that. Despite all of those traditional, tried and true, universally accepted concepts of rising wedges, double tops, head and shoulders, the market finished higher as of Friday. You've been deceived. Your eyes have deceived you. It is front and center right here. This is all been a lie. The market makers have, for the most part, I can tell you, successfully deceived the vast majority of traders who use traditional price patterns to make trading decisions. You have been lied to. I'm going to take a movie clip from The Matrix. Let's play that.
Instead, only try to realize the truth.
What truth?
There is no spoon.
What you have been looking at for the month of January is what you thought to be a spoon, but there was never a spoon there at all. All those rising wedges, all these price patterns, that wasn't a spoon at all. There was never a spoon there. Now I'm going to start to share with you the hint of what's really been happening. This is what I shared on Friday. Consolidation underneath the EMA 50, right here. This is an intraday Friday pattern. The whole month of January has been a consolidation pattern. You're like, what? Oh, you're going to see in the next slide what I'm talking about. It's been one giant consolidation pattern. Okay? Make a mental note of this. You see this gray dash line? I'm only going to mention that now. You're going to see that more clearly, way more clearly in the next slide. Just take a note of that. You see that gray dash line? Okay, this is the main channel that we've been trading intraday with. Everybody knows that. Everybody knows that line. Here's the weekly expected move, 403 green line. Everybody knows that. You guys have been trading with me on Twitter. Watch the gray line. The gray dash line. It took it back on Friday. Okay, I'm only going to mention that for now. All right? So, here's January 4th, right here. On that day, I tweeted, guys, I think we got an official trend change. Okay. How did that turn out? All right. It boiled down to a 5-minute EMA 50 observation intraday. That's what it actually boiled down to. And if I can go back to this original slide right here, breaking things down into their smallest fundamental elements. The 5-minute EMA 50 is the smallest fundamental element. I've been preaching in all my episodes. Don't look at the 1 hour. Don't look at the 4 hour. It starts with the 5-minute. Sometimes the biggest things come in small packages, don't they? They sure do. Okay? That's a very important lesson. All right. So, let's get to the next slide. You are about to see the matrix, the full matrix. Okay? On December 7th, I released this video to the YouTube sphere. Almost 2 months ago. There was a secret pattern that was revealing. It was a rising channel. Nobody on YouTube was calling that out. Nobody. I saw it on December 7th, or thereabouts. And what did I see? this. See this big gray line right up here going up top? That goes all the way back to September. September, I think it was like 21st-ish, thereabouts. 1213 wick high. Connects, 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 connects. Interesting. Guess what goes parallel with this? It's that. See this? Remember that gray dash line I told you a moment ago to just take a mental note of that we closed out on Friday? Yeah, guess what? We just took that back on Friday. We took back the bottom of that rising channel that we lost in December, that I had identified was forming. We just took it back. The entire month of January effectively bottom itself at the hive, come back up and consolidate just under that rising channel, and you took it back on Friday. You took it back. That is what you were deceived with. All the while, the market makers threw in 3 rising wedges, some quadruple tops, and some double tops, triple tops, to get you to think it's going lower. All the while, it was consolidating under that channel. And on Friday, it took it back. How about that? Now do you see what it's really been doing? This has nothing to do with rising wedges, falling wedges, whatever. What you are looking at is the path the market makers are using to get to its ultimate destination, which is up here. SPY 421. That's where it's going. I'm not saying it's going to get there this week. I'm not saying that at all. That's where it's going for. And I'm going to show you irrefutable evidence that that's where it's going to. This week, I think it's going to target 412. And you'll see in subsequent slides why I say that too. Okay? Now, you see this purple line? Oh, the 1213 wick high. That's at 414. That's not that far away now, is it? That's not that far away, is it? Let me ask you this. You spent all this time consolidating right here at the hive. All this time consolidating under the channel bottom. And I told you, anytime you consolidate under a line, that's bullish. That's not bearish. You think they're going to let FOMC destroy all that in one day? I'd like to see how this is going to play out. Notice I'm not making a projection on what I think is going to happen at FOMC. I'm showing you the hard work, the path this market is taking, and the lines they are respecting every single day. You think they're going to let Jerome Powell throw it all away? I find that hard to believe. But notice I'm not making a projection. Okay? I'm just kind of saying that for now. 1213 wick high. A lot of YouTube channels bragged. We shorted it at the top. We shorted it right there, by golly. Well, your shorts are going to start losing money if they haven't already. You probably bought a lot of long-dated, out-of-the-money puts. We're right back up there again. And now you've got time decay. So, are you still going to brag? I know some YouTube channels were bragging. Ah, we shorted that at the top. Yeah, that's right. That's it. I'm calling it. Here we are, rapping on the door again. Okay? Neo in the Matrix Revolutions, as you know, was blinded in his fight with Agent Smith in the real world. But, like the Rubik's Cube champion who can solve the Rubik's Cube in 17 seconds blindfolded, Neo didn't need his eyes to see. When he told Agent Smith, I can still see you. Don't look with your eyes. Because that's exactly what the market makers want you to do. They want you to look at that spoon and say, yeah, that's a spoon. There is no spoon at all. It was bullish consolidation in the month of January. There you have it. See? So, here's what we're looking at now, the 65-minute chart, a little bit more zoomed in. There's that channel bottom that it reclaimed. Guess what? And if you really look closely, it lost it. I mean, look at this. That old channel bottom, the 1/8 channel line, the 65-minute SMA 20. That is serious support. Serious support. And if it loses that, you got the channel or the old channel top right here and the old weekly expected move. But here's the old channel top. So I'm going to ask you a rhetorical question. After all this time, you're going to let Jerome Powell with a 25 basis point hike tear all this down? Really? Really? Because I'm going to show you something a little bit later too that's like, hey, look, guys, it's not the inflation rate at 5% that's going to bring down inflation. It's actually the Fed balance sheet. And I'm going to show you that. It's a mathematical certainty. It's the Fed balance sheet, not the 5% interest rate that Powell wants to stick to. It's the Fed balance sheet. And the markets know that. If I know that, the markets know that. Okay? So I want you to keep all this in mind. Now, it was, zoom in, January 20th, Friday, January 20th, the Friday before this past Friday. It was the weekly wrap-up on Friday, January 20th. I put out this slide. I said, all right, guys, here's where I think it's going next. 403. Look at that. That was before the weekly expected move was calculated on that following Sunday. 403. You look at that. 406. But actually, if you look at the gray line, it's between 405 and 406. Where did we close on Friday? 405.68. How's that? But now look, 411. But look at the gray line. It's just past 411. How does 412 sound? The exact channel midline, to be precise. You think that's an accident? Oh, heck no way. No way. I'm not naive to think, though, that it's a straight line. I'm not saying we can't go down first before we go back up. That's Actually, that's an expectation. Gotta have some pullback. It's not just go with straight line, B line, like a 45-degree angle straight to 412. If you can get to 412, then why can't you get to 414? The 1213 wick high. Why not? That's just right there. Okay? Now, here's what I want you two guys to look for tonight in Sunday futures tonight. I want you to watch for this. I'm not going to make a prediction, but I want you to watch for this. If futures tonight kind of glides upwards at an slight upward angle, that will show it's following that line. So in the previous slide, I had the words should crossed out versus does, green check marks. Don't ever say that it should do something, because now you are introducing a bias in your decision making. Because the word should is debatable. And I would also say, when you say should do something, like a rising wedge should fall, now whose rules are you applying? Your rules or the market maker's rules? When you say something should happen. I prefer to stick with observations that do or does happen, not should happen. So, tonight, check it out. In futures, if it's floating up, kind of floating up. It's like tomorrow morning's futures are slightly up. Slightly. Then that tells you the market maker does, not should, the market maker does respect this channel bottom. So notice again, I'm not making a prediction. I'm just telling you what to look for. And if that observation is true, that the market does respect this channel bottom all night, then now you have one more hint into the market algorithm. Notice I'm not talking anything about FOMC and whether I think you're going to get to SPY 410, then you're going to crash. Oh, I don't get into all that. I'm sharing simple observations, such as if things start at the 5-minute EMA 50, guys. Breaking it down. Simple observations. Is this true? Okay. If it's true, then this must also be true. Right? Remember our true and false discussion yesterday? Same thing applies today. I'm not telling you what it's going to do. I'm just telling you, look, watch for this. See if that happens. I have no expectation whether it should happen or not. All right? So, SPY 412 is the intermediate target. SPY 421 is the ultimate target. Okay? Because I'm going to tell you, if that 1213 wick high gets taken, you betcha. You betcha. Okay? Oh, watch out. Now you're making new highs. Watch out. If that 1213 wick high gets taken, I'm going to show you why it's going to 421 in a minute. I've covered this in previous episodes, but I'm going to share it with you again. Okay? Now, if 421 is taken, big if, this is a major channel top, just like this is a major channel top, right? It's been fighting 7 times to retake this channel. So I'm not saying it will, but this is tough. This is tough. SPY 420, 421. But if it is reclaimed, that would have meant you've taken out the 1213 wick high, and you've taken this out. And that is where I'm going to shift discussion away from the hive to the drone. All right? That is where we're going to start having that discussion. The whole bear market talk, it's done. All right? So, now I want to show you guys something that we call just good old-fashioned data and information. Okay, here we get over here. Oops, nope. Zoom in. A lot of you are familiar with, but not all of you may be familiar with the Fed balance sheet. It just consists of Treasury securities and mortgage-backed securities. Okay? Now, Treasury securities are just Treasury bonds. They're just bonds and mortgage-backed securities. That's all you need to know. Okay? Consumer Price Index. That's the red line. Total balance sheet, Fed balance sheet, is the blue line. When I draw a regression line, which you know I like to do, right through the middle of this, doesn't that kind of look parallel with the CPI? And notice nowhere in here is the Fed interest rate. It's the Fed balance sheet, guys. That's what's determining CPI. And as I've shown in that previous video, that the markets have already priced this in, guys. They've already priced all of this in. Right here. They've priced it in. Even though physically there's still 8.5 trillion in the markets. Physically, but the markets priced in. They wrote all of this off and returned back to 2020 on 10/13, the hive. So, this is just straight math. This is not my opinion. Oh, they've already priced it in. Go back and look at those previous videos that I've done if you want to get details of how I calculated all of that in. Okay? Now, I want to show you guys something as well. Hold on just a second here. It is going to just take, here we go. Take a couple of moments. It's just takes a moment to open now. I did this in that previous video. It was, hold on a second. Let me show you the couple of videos if you want reference. Here. Markets master plan, markets priced in. Okay? Whole lot of details because I spent 54 minutes on that one, 41 minutes on that one. So I got a whole lot of details in that. Here's the net that I'm showing. This is from those videos. Here's the net. The markets are currently pricing in a 2.69% federal interest rate, terminal federal interest rate. I know right now we're talking about 5%. But I'm talking about what the markets are currently pricing in. Currently. That's the actual versus projected, right? Projected is 5%. That's what the Fed wants to get to. But the actual that the market is currently pricing in is 269. Okay? So in those videos, I did detailed analysis that came to, the market is currently at 2.69 and currently projecting a future return of 10.5% for SPY year over year, which is well below the 10-year average of 15.426%. That's a 50%, actually, well, yeah, 5. Actually, that's about a 31%. Yeah, 31%. That's a 31% reduction. They've already priced it in. They've already priced in the fact that we're in a recession, because when you're at 10.5%, that's a significantly lower number than the historical average, the 10-year average of 15.426%. They've already priced in a recession. They've already priced out 4.5 trillion out of the Fed balance sheet. That price point of SPY 348.11 was met on October 13th. On that day, when SPY hit 348.11, that had priced in 4.5 trillion off of the balance sheet. So be careful how you draw your conclusion as to the true impact of this Wednesday's FOMC. Okay? You got to use math, guys, at the end of the day. Because my personal opinion doesn't mean squat. My personal opinion doesn't mean anything. You got to figure out what the market has already priced in. All right? So, 421.23 was my calculation. I said, that's SPY's target. That is SPY's target for 2023. 421.23. Guess what? On August 19th, 2022, it left a gap. 421.22, 419.96. It left a gap. I was off by a penny. 421.23, 421.22. I was off by a penny. But look at that. 419.96. Well, that sure looks interesting, doesn't it? Oh, no, I don't want that slide. I want 420. 419.96 is 4 pennies shy of 420. All this coincidence? Oh, heck no. No. But again, I'm not naive to think it's a straight line. So let's just see what impact FOMC really does have on the markets. I don't know what the impact is going to be. But you spent the entire month of January consolidating to get underneath that channel again, and Friday you took it back. Are you just going to give that up? Would you? Especially when you know the Fed is at the end? Not at the beginning. Not at the beginning. At the beginning of the rate hiking cycle, that's what led to the October 13th low. They're at the end. They're at the end. Not at the beginning. So I'll say that again. All those 4 consecutive 75-point rate hikes led to the October 13th low. And now you're at the end, and you can expect something the Fed's going to do is going to cause the October 13th low to be broken? What could that be? You're going to give us 4 more consecutive 75-point rate hikes? No. So you see, how does the math cause the October 13th high low to be broken? How does the math cause that? There you go. So that concludes today. Please follow me on Twitter, where I'm giving real-time tweets intraday. Seems to be going okay so far. So far, so good. We'll just say that. And please don't forget to listen to your favorite music while you are trading. Helps you get into the right state of mind and helps you get into the zone. Please give this video a like, share, subscribe, or click to be notified when I release something new. With that, I'm Agent 000, signing off.